Hey everyone, and welcome to this explainer. Look, today we're cutting right through all the usual noise to look at some truly essential strategies for smart market investing. We're going to dive into some highly effective frameworks to actually put your capital to work. No dense theoretical jargon here, just practical, actionable methods. Our goal is to break down the exact systems you can use to allocate your funds effectively and, most importantly, with absolute confidence. Let's get right into it.
So let me ask you something. Do you want to invest without all that tension? Because for a lot of us, the absolute biggest barrier to consistent investing is the constant anxiety of market volatility. You know the feeling, trying to do the impossible and time the absolute bottom of the market. It's just constant apprehension about sudden downturns. But the good news is, there are proven, systematic methods to allocate your capital that literally remove this timing anxiety altogether. Let's break down how our source material approaches this and figure out how to build a portfolio that actually lets you sleep at night.
Section 1. Easy Investing Methods.
Okay, so generally speaking, there are two main mindsets when you're putting your money to work. You've got the immense stress of trying to time market bottoms versus the smooth, systematic approach of a SIP or dollar cost averaging. If you're out there trying to guess exactly where the market is going, you're probably going to end up making emotional decisions and missing out on great opportunities. But if you flip the script and just invest a fixed amount on a fixed date every single month, you automatically lower your average purchase rate over time. Think about it. When valuations drop, your capital naturally buys more shares. When they rise, it buys less. The source highlights this as the ultimate zero-tension method. You automate your entry, you average your costs, and you just step back and let time do all the heavy lifting for your long-term growth.
Moving on to Section 2, the powerful 80-20 rule.
Picture your total investment capital split into two entirely distinct buckets. First, you take a massive 80% to act as your core. You park this in safe, broad market index funds to build a totally unshakable base. Since this tracks the broader market, it completely insulates your portfolio from any catastrophic single company failures. Then, you take that remaining 20%. This is your satellite. This is the money you deploy for calculated, higher risk, high reward plays. Here's the beauty of it. If those satellite bets fail, your core is right there to preserve your wealth and keep you on track. But if they succeed, you capture incredible extra profit right on top of your safe base. It is a brilliant way to balance strict defensive safety with calculated offensive strikes.
All right, Section 3, 3 stock picking approaches.
So once you've allocated your money, how do you actually pick the shares? Well, the first mindset is value investing. This is essentially bargain hunting for strong, established companies that the market has completely mispriced or undervalued for the time being. According to the source, the secret here is a strict focus on fundamentals. You want companies with incredibly low debt and solid, consistent earnings. You're basically buying legacy strength at a massive discount, and then you just sit back and wait patiently for the broader market to finally correct its pricing error and realize what that asset is actually worth.
Now, in total contrast to that, we have growth and momentum investing. Forget bargain hunting. Here you're looking for companies that are scaling at light speed and you are jumping onto a moving train. You're buying in, even at seemingly sky-high valuations, simply because their year-over-year sales and revenue are expanding so dramatically. The source specifically points to new technology sectors as prime examples of this. In these scenarios, you're betting purely on sheer momentum. You're confident the company is going to capture so much future market share that today's premium price tag won't even matter in the long run.
And our third approach is dividend growth investing, which is absolutely ideal if you're looking to generate passive income. With this strategy, you target those super reliable heritage companies that systematically hand a solid chunk of their profits right back to you, the shareholder. The source calls out everyday inelastic sectors for this. Think utilities, consumer staples, pharmaceuticals. Because these businesses provide goods and services people literally need to survive, their cash flow stays steady even when the economy tanks. They offer reliable, compounding returns year after year, reinforcing your entire portfolio with a steady stream of predictable income.
So, pulling all of this together, we're really looking at three entirely different ways to play the market. Value investing targets cheap, low-debt legacy companies just waiting for a price correction. Growth investing is out there hunting for rapid, aggressive scaling in spaces like new tech. And dividend investing, that's all about reliable profit sharing from essential everyday sectors. Now, each of these requires a fundamentally different mindset, a different time frame, and a different appetite for risk. But understanding these distinctions is absolutely crucial because it lets you perfectly align your stock picking strategy with what you actually want to achieve financially.
Which brings us to Section 4, what's right for you?
So, I want to leave you with the exact question posed by our source material today.
Which of these methods actually feels right for you? Are you that steady, set-it-and-forget-it SIP investor looking to average your entry over time? Do you love the calculated, risk-adjusted safety net of that 80-20 core and satellite rule? Or maybe the deep value hunting, the aggressive momentum of new tech growth, or the steady cash flow of dividend income is what really aligns with your personal goals? Look, the most important thing is executing a plan that fits your own psychology. So choose your path and take that first tension-free step into the market. Thanks so much for joining me for this explainer, and I'll catch you next time.